Well, good afternoon, everyone, and welcome to this afternoon's webinar, Cash Balance Marketing and Prospecting. My name is Brian Smith, and I'm the Senior Institutional Sales Director for July. And just a couple of housekeeping items real quick. Your lines have been muted, and this works really well when we have some interaction. So at the bottom toolbar on your Zoom screen, there's a Q&A function. If you have questions that come up during the presentation, please fire those away, and I'll do my best to answer those during the presentation. And we should have some time at the end to also answer any questions at the end, but I'll be monitoring that Q&A section. There's also a chat one. If you could not use that one, because I don't have that one up, just again, use the Q&A one. But we should be through and allow enough time at the end. So additionally, this is being recorded and will be sent out in a couple of days at concluding today's presentation. So you can go back and take a look and maybe pick up something that I forgot to mention or what have you. So with that, we're going to go ahead and get started. And for those maybe new to July or that have heard of us, but just a little refresher. July was founded 30 years ago, actually, this year. So we've been at this a long time. Our roots are founded in the CPA and TPA world. That's where we started and then entered into record keeping many years later. Today, we have just shy of about 8,000 plans and a little over 11 billion on our record keeping system, comprising of just shy of about 200,000 plan participants. We have a national presence with a sales team scattered throughout the country that is all very credentialed and certified in this world of pension design and administration. Many have the QKAs and QPAs and other designations, and again, a long tenure in the 401k defined benefit space. About 450 or so employees make up July. So we're still, small in comparison, but again, have a lot of breadth and depth with regards to plan design, administration, record keeping. Today, again, we're going to focus on the cash balance side, but a big piece of what July does, of course, is on the 401k side as well. Pretty proud of our in-house software. We have about 40 software developers on staff. So our tech and experience our customers have with July, we feel is an exceptional one. And we do get a lot of great feedback around the enrollment side and client portal and the technology that's available there. A lot of tools on the website. Today, we'll share maybe a few that pertain to the cash balance plans, but lots of tools and tech out there on the website. And other partner solutions, calculators, tools, and all of that. July is what we refer to as 100% advisor centric. So we don't market direct to plan sponsors. We need you. We only do plans through advisors. So being advisor centric, our service model for advisors, again, starting with a national sales presence and internal sales team. The team is able to run proposals and plan design, hypothetical illustrations, conduct webinars and CE meetings, deep, again, consulting roots. We like to refer to ourselves as retirement plan consultants more than, product, maybe wholesalers. Very hands-on out throughout the process at July. You have dedicated individuals. We do not believe in the 1-800 who do you get next model. Right, we're dealing with small business owners, and they like to speak to a live body and know who their people are. So very hands-on, dedicated, client service managers and installation managers. And again, can't stress enough, we need you, and really appreciate you all taking time out of your day-to-day to join us. So real quick, our path today. We're going to do a refresher on what is a cash balance plan. We have a series of cash balance presentations. We give kind of a 101 and a 201 where we get into some more advanced topics. Today, we're going to hit on some of those, but as a refresher, maybe not dive as deep into there. Really focusing today on who are the ideal candidates, how things to look for, how do we market and prospect these types, right? So best candidates, but along with that, there's also some, common pitfalls we want to be aware of. This design certainly is not for everybody. I always hate when I have to say no, right? Because it's better to do that now and understand versus getting into something that we probably had no business being in the first place. And then talk about the resources and tools and things that we have available to help you. So let's get started with, again, what is a cash balance plan, right? Well, a cash balance plan in simplest terms is a type of defined benefit plan. So if you think of the two types of retirement plans, defined contribution, which your 401k profit sharing plans are, and then defined benefit plans, which are your traditional pension plans, and then cash balance plans. We call in the industry a cash balance plan oftentimes a hybrid plan because it actually looks a lot like a profit sharing plan. But again, it is a type of defined benefit plan where we are specifying a benefit at a future date. Whereas a defined contribution plan, right, we're defining how much I'm putting in each year, right? I'm going to put in $15,000 into my 401k. I'm going to get a $3,000 safe harbor contract, whatever, right? Again, defined benefit, defining a benefit at a future date. Unlike a 401k plan where the individual participant bears the risk of investment performance, in the defined benefit plan, it is actually what we call trustee directed. And so the risk really is on the employer to understand and work with their advisor on the appropriate asset allocation or investment menu for that plan to make sure the benefits are there at the end, right? You've heard stories about, DB plans being terminated because they were too expensive and they were underfunded and needed bailouts and all that. Again, that's because the risk is on the employer. Contributions, we're going to get into more of this. They are obligatory. They are required in DB plans where in a profit sharing plan, right, a business owner can decide, do I want to do it? How much do we want to do? And that can vary from year to year. And lastly, unlike a 401k plan where each participant has their own account, in a cash balance plan, we call them, again, trustee directed or a pooled account where everybody is in one giant pool and then the actuary basically tells each individual how much piece of that pie they have accrued as a benefit. And how it got its name, kind of rocket science here, right? Cash balance. The benefit is expressed as a lump sum, i.e. a cash balance, versus an annuity type of pension where, you work so many years and you retire and you get this income stream in retirement like a traditional pension. By the way, a quick slide came in. Yes, the slides will be available concluding. Yep. So a couple more sort of lingo or terms we use with cash balance plans. We talk about participants having a balance. Well, it's really a hypothetical account because that balance will vary and change because what the actuary is technically doing is calculating an accrued benefit, again, that should this person, terminate today, here's what their balance should be worth, or I reach retirement age, here's what that accrued benefit should be worth. So oftentimes it's referred to as a hypothetical account. The cash balance plan has really two components to them and how these plans grow in assets. The first is from a contribution or what we call a pay credit. That is an amount specified in the plan document that is either a percentage of pay or a flat dollar amount. So for example, my benefit is $200,000 or 75% of compensation, right? That is the contribution credit or pay credit. The second part is, and unique to these plans, is there's a guaranteed rate of return called an interest crediting rate. So you have that contribution plus the interest rate. That is the growth of the plan. Today, that is 4%. So when we go to invest assets, and we really talk about this in 201, right, we're trying to target a 4% rate of return. We're not trying to hit a home run here and get a 15, 20% rate of return, and we're certainly guarding against the downside where we might have, a negative 25% rate of return. So again, both the credit and the interest crediting rate are specified in the plan document, and to change those requires a plan amendment. And then each individual is assigned a credit. So owners might be at one and managers at another and staff at another, right? Much like a profit sharing plan where we can give different percentages, we can also give different benefit amounts for different classifications. Kind of already did most of this, but kind of comparing a traditional defined benefit plan to a cash balance plan and to a 401k plan. So a couple again that to reiterate, the investment risk in a 401k is on the employee, and defined benefits, that's the employer. The account is pooled in a cash balance plan, an individual account in a 401k plan. PBGC coverage. This is an important distinction between defined benefit plans and 401k plans. This is the government's insurance agency called the Pension Benefit Guaranty Corporation. All defined benefit plans are required to have premiums paid into the PBGC unless you are exempt. And so sometimes a cash balance plan, depending on the industry of that plan, you might be exempt from the PBGC. And then the retirement benefit formula, again, different from a traditional plan, which kind of more of an annuity based. This is expressed as a lump sum or cash balance. So why cash balance plans? Really, there are a number of reasons, why an individual owner or company might consider adopting a plan. Primarily, this is a tax strategy, right? So that center box in the bottom row. I would say, probably 9 out of 10 plans, we're creating a significant and immediate tax deduction for that business owner. So again, it's really part of an overall tax strategy. Yes, it's a qualified plan. Yes, it's a retirement plan. But primarily, again, really seen as a tax benefit. The goal usually is to maximize benefits to the highly compensated employees or owners or partners of a firm. We're trying to then at the same time minimize the cost to the staff. Being a qualified plan, the staff still needs to get a benefit, right? I can't do this just for owners. Trust me, we would be very popular if we could do that. But we were trying to minimize those costs. And sometimes it's not always easy, right? And we'll talk about, sort of demographics and things in a moment where that sometimes is a challenge. But oftentimes we're trying to maximize for HCEs, minimize for staff. And another then that bottom left, another sort of point of interest in these plans is to accelerate or play catch up, right? Their retirement savings. Oftentimes you'll see some examples where it might be 2, 3, 4 times the amount that they can do in a 401k plan. And so here's a way to really play catch up or accelerate some retirement benefits. So some things, some statistics here on cash balance plans. Seen tremendous growth really in the last 15 or so years, mainly because of a piece of legislation called the Pension Protection Act that was passed in the late 2000s, I think 2006 area, which changed a maximum deductibility sort of limitation that small businesses had, right? They were already maxing out profit sharing and really didn't have maybe extra room to add another plan. And the Pension Protection Act changed that. So since then, we've really seen tremendous growth year over year with those that are adopting cash balance plans. Small businesses definitely are the drivers of this, right? 95% of all cash balance plans are with firms that have less than 100 employees. And of that, over 60% have less than 10. So again, you're talking really small, closely held. Think of physician offices and dental practices and firms like that. You'll see in a moment kind of the industry dynamics here, but those are who are adopting these plans. With that said, though, we've seen growth the last number of years in various sectors like technology and finance, manufacturing, home building. Now, home building slowed down a little bit, right? But during COVID, you saw other industries like RV sales and boat sales, right? Certain industries that were doing really well and thriving during the pandemic were looking for tax shelters. So again, it can work for anybody, and you'll kind of get an idea of companies that are a little bit more likely to adopt here in a moment, but lots of different sectors. And then states that have higher tax rates, right? States like California, New York, etc. There's no secret why you see more adoption there. That's because when you factor in federal, state, and local taxes, right, you could be 50% in taxes, and putting $500,000 away, saving you $250,000 in taxes is pretty attractive. So a couple more things to talk, about some of these, right? Cost efficiency of cash balance plans, trying to, maximize benefits for the owners and create a tax deduction, right? But another important factor is asset protection, right? As with other qualified plans, generally speaking, dollars in qualified plans are protected from creditors. So getting money off a balance sheet, getting it into a qualified plan is often a pretty safe bet. I mentioned that catch up or accelerating retirement savings. One kind of group that has come to mind over the years with this are like dental practices, right? Yeah, you have a young dentist who has paid off dental school and has been working and now maybe is bought into a practice and is paying off the practice and is now 40 or something like that, right? 40, 45 years old and sitting here thinking, right, I need to really ramp up or accelerate my retirement savings for the next 15, 20 years. Here's a way to really, catch up quickly by doing 2, 3, maybe times what we could do inside just a 401k plan alone. And then in another area, really, the workforce has become extremely competitive. And, I've heard stories where potential candidates are evaluating company A and company B and what's their retirement program look like. And a cash balance plan as part of an overall benefits package for an employee is certainly a way to help attract, retain, and reward talent, and can go a long way, again, with securing some maybe key individuals. And then some of the growth in these plans, you're looking now over $1 trillion in a short period of time with not that many plans, right? Because these plans are usually hundreds of thousands of dollars a year and quickly, right, accelerate. So you see the median size is just shy of $750,000. And 33% of these plans have over $1 million. And so if you're thinking about growing my AUM, here's a way to a 401k plan may grow 50, 75, 100,000 a year. Cash balance plan could grow $500,000 a year, if not more, right? So lots of AUM potential with these strategies. And again, the number at the bottom there, the vast majority of these are with companies with 10 or fewer participants. So mentioned rising taxes, right? Rising federal, state, local taxes, certainly has motivated a lot of individuals to consider these plans. The hybrid appeal of a cash balance plan, right, looks a little bit like 401k profit sharing plan. Actually, they are paired together for compliance testing and non-discrimination testing, right? But there's more flexibility maybe than in a traditional defined benefit pension plan. And maybe less risk, so that this hybrid appeal certainly has been popular. Legislative changes, right, can continue to see ever since the Pension Protection Act of 2006 change. Tax rates changing. All of these things will have an impact in our business, and certainly has created tremendous appeal to the cash balance plan with those changes. And then, retirement savings crisis. We all know the numbers, right? We've heard it many, many times. And I was at the ASPA conference a couple of weeks ago, and you hear the stories that 50 million plan participants or workers, still lack access to a workplace sponsored plan. And so, employers that are adopting plans and giving benefits to employees is certainly helping, individuals try to get closer to their retirement goals. In terms of replacing traditional DB, this is maybe a little too technical, but One of the areas that we've all heard, right? The traditional pension companies have shut them down, right? That's because really of risk. These have a lot less risk, but it's also not necessarily apples to apples because we're not doing a lot of cash balance plans for Fortune 100 companies or companies that have thousands of employees, right? But there is certainly lower risk than a traditional pension plan. Cost, certainly, these sort of runaway costs of a big, huge workforce retiring and a company being responsible for all of these benefits. You don't have that in cash balance plans. It's actually easier for employees to understand, right, and appreciate. I'm going to get X benefit every year, towards my retirement. Pretty simple to understand instead of trying to figure out some formula of my highest working 3-year average for this many years equals this annuity, right? So just easier for employees to understand. These plans allow for a consistent contribution rather than, maybe uneven age-based calculations of traditional pension plans. So, certainly probably back with easier to understand, but a little bit more consistent. And then last, portability. The nice thing about a cash balance plan, when you terminate, when you separate from service, you essentially take your accrued benefit and you roll it into an IRA. Once it's in your IRA, that individual, you are free to do what you want, right? You want to invest it aggressively. If you want to start drawing income, whatever the case may be, once it's out of the plan, right, it's yours and yours to do what you want, but completely 100% portable. Definitely an attractive feature of the cash balance plan. So here's a fun stat that's interesting depending on where y'all are calling in from today. But here you see the top 10 states. And by the way, this was taken as of 2022. The 2023 data hasn't been compiled yet. But as I mentioned, you see the states that are leading. Again, no surprise there. But Georgia was one. When I saw this, I was like, whoa, Georgia came out of nowhere and had a 10% annual increase and is now in the top 10. So that was pretty cool to see for Georgia, if anybody's down there today. But again, if you think of states that have higher taxes, if you think of states that have more focus on industry and growth of businesses, like I live in Columbus, Ohio, and we have a big Intel plant, right, that's being built, and Intel coming here adding a bunch of jobs, right? So cities like that where business is coming and growing and a thriving workforce, right, you might see those states start to pop up on here. So you've heard me mention maybe 2-3 times what you could do in a 401k plan. This chart will show you that. So what you see on the x-axis is the age of an individual, and then up the y is the dollar amount. So in a 401k plan, in the blue box, it actually it's not just deferrals. This would be deferrals and safe harbor and profit sharing. So it's the 401k limit or defined contribution plan limit. We'll just choose a 50-year-old right in the middle, right? So the limit for the 415 limit for this year is $69,000. If you're over the age of 50, you get an additional $7,500 catch-up. So $76,500 is the limit for any one person. That's the most they can do in a 401k plan. Take that same 50-year-old and add a cash balance plan, you see nearly a $260,000 additional benefit in cash balance, right? So, greater than 3 times what the 401k plan maximum could do for that individual. As you notice, this green bar climbs. That is because the calculations of benefits are age and compensation driven. The older you are, the less time you have to accrue your maximum benefit, thus resulting in a much larger benefit, right? So a 50-year-old has a little over 10 years. We typically use age 62, so 12 years to normal retirement age in a defined benefit plan, where, right, as a 40-year-old who's got, 22 years to normal retirement age. So that 50-year-old can do a much larger benefit than the 40-year-old. We really don't see plans too often much younger than 35. In fact, when you get below 35, it really drops because, again, you have so long to accrue. And by the way, the maximum accrual right now is probably around $3.4, $3.5 million, give or take. It fluctuates with interest rates. So, right, a 30-year-old putting in 100,000 compounded for 30 years, right? Here's my $3.5 million. Kind of simple math for you there. So with that, let's talk about then, candidates and industries and kind of things to be looking for when it comes to the cash balance conversation. First, this really is a win-win-win scenario. In fact, I'd almost add a fourth win on here, and that is CPA, right? So clearly the business owner is winning here with large contributions and significant and immediate tax deduction. Advisors are winning, as I mentioned, steady, sizable new AUM flows, right? Employees win. They're getting increased benefits to their retirement savings. And then CPA on here, right? Recommending this strategy to a client. Client trusts the CPA more than anybody else. This goes a long way in securing that relationship. And by the way, we really don't get into this presentation a whole lot about working with the CPAs, but little sidebar takeaway here. If you're having this conversation with a business owner, I would strongly encourage you to make sure the CPA is involved from the very beginning. Without the CPA's blessing, this is going to be a difficult sell. I've been in hundreds and hundreds and hundreds of these meetings, and we almost always will need the blessing of the CPA. So again, strongly encourage working with them and keeping them in the loop and getting them involved right from the beginning. So yeah, win. Question just came in. Can we use this for owner-only businesses? Absolutely. In fact, a solo cash balance combo is extremely powerful, and we don't have to worry about non-discrimination testing. So yes, you'll see in a moment. Thank you for asking the question. Some of the resources, one, we do have a calculator for solo plans. So yes. This slide here is probably, if I could literally, if you remember one thing from today, and I hope you'll remember more than one, but number 2, the green rectangle here on the screen is the very most important consideration of any business. I don't care what industry you're in. I don't care how you're taxed. What is the most important really comes down to cash flow. And that is, do we have steady, predictable, consistent profit cash flow? Everything else on the screen I'll hit on in a minute is important, but this is the most important because this is where the funding comes from for making those contributions, right? So when we're weighing the candidacy here, and are you a candidate or not, right? If your income or your cash flow is a roller coaster, not that we can't do the plan, but maybe we want to design it a little bit more conservative so that in a bad year you can still come up with the funding, right? But if you're so tightly wound and take an independent contractor and 85% of their income comes from this one business they're consulting for, and their contract's not renewed, and their income again goes to zero, right? Probably not a great candidate in the beginning, for this plan. So there's some other things we can talk about with when that stuff happens, right? But when you think about who's a good candidate, this, again, I can't stress enough, is the most important factor. Consistency with cash flow or profits above everything else is the most critical. Couple questions here real quick. When would someone use an actual interest credited versus a predetermined, say, of 5%? Yeah, that's a pretty interesting question. What you're talking about there is an actual market return for the interest crediting rate. You don't see that too often in the small space. If you do, there's usually a floor and a ceiling. So might be a floor of 4 and a ceiling of 6. Might as well have just done 5 to begin with, right? The reason is the relationship that the actual rate of return has on testing and has on benefits, right? A higher interest crediting rate is going to mean a lower maximum benefit, a lower contribution. So typically, again, in this space, we see flat, steady, guaranteed, rate instead of an actual rate of return. And another question, can a client do a cash balance plan if they already have a fully funded DB? Possible. That one, we would need to evaluate the accrued benefit for that individual or for those people, because there is a maximum accrual unless it's a whole new business, right? If it's a new entity that this person now works for and they had their DB over here, yes, you could do it, over here. Typically, I'm going to say no to that answer, but the answer is it depends. And certainly happy to discuss that again further. Great question, guys. Keep them coming, by the way. Love it. So back to the other, things on here. Things to look for. If you're already maxing out your 401k profit sharing plan, you could be a good candidate, right? What happens sometimes, though, is the business owner hears, well, I'm maxing out. I've told this is all I can do. Yeah, that's true in that plan, but we can stack on, add this cash balance plan, and now we can, definitely go above. So businesses already maxing out using, profit sharing could be a great candidate. And the delta, the change, especially in the cost to the staff, might be minimal, right? Might add an extra % or two, to the staff members. I'm going to come back to the orange one. Larger contributions, again, businesses that are already, doing, profit sharing 3, 4, 5%, and you're willing to go up a little bit higher, you could be a great candidate. We talked about accelerating the benefit on the right. In the middle, the orange, the age matters. This is a close second to the green one, right? I mentioned that all testing is based on age and compensation. In fact, that's how profit sharing, new comparability, if you guys really want to get into that, that's how that works too. It's about the time value of money. And the testing basically works really, really well when you have older owners with high compensation versus younger staff, lower paid staff, right? And so, 55-year-old owner and average age of 25, 30 for the staff, perfect. I've gotten a few lately where we have young 30-year-old owners and the staff is all older. This is very difficult, meaning the benefits that the owner would have to give to the staff to equal or satisfy the testing is going to be far greater than they're comfortable doing, right? I'm already paying them $75,000. I don't want to give them $25,000 between profit sharing and cash balance, right? Something like that. So age, think about age, older owner, younger staff, these plans work really, really well. Another question came in. Can you elaborate on the limits for a solo K cash balance combo? There's a limit of 6% on the profit sharing. Yes, that is absolutely correct. Someone has definitely talked about this before. So, real quickly, in a solo arrangement, when a solo owner is going to add a cash balance plan, that is one of those exemptions from the PBGC that I mentioned. There's another exemption, and that is a professional services company. So think of if you went to some extra schooling, typically, right? Physicians, dental practices, attorneys, financial advisory, RIA firms, and companies like that. If you're a professional services company with fewer than 25 employees, you are also exempt from the PBGC. Great. Good thing I don't pay premiums because we're not covered by them. I guess the thinking is they're less likely, those businesses, and especially solos, you don't have employees to worry about, but you're less likely to default on the promised benefits to these individuals. So you're exempt. That's great, right? I totally agree with that. I think it's great. The problem is then if you are exempt, you are subject then to a maximum combined deductible limitation. And you have basically one of two choices. Choice one, which almost is never an option, is that the combined contribution, the combined deduction between both the 401k plan and the cash balance plan can not exceed 31% of compensation. So simple math, let's say I had, $200,000 of compensation. My maximum benefit then in that scenario, right, would be $62,000, 31%. of total compensation, $200,000. Or option B, you keep the total deduction in the profit sharing plan to no more than 6%, and then you can deduct the entire cash balance amount. So that 50-year-old with 200,000 can deduct 200,000, right? You can definitely do 100% of pay, by the way, in these plans, depending on your age. Right. So that option is almost always going to be better than option one. So that's what that question was talking about, is when you see someone that has been maxing out their solo K, my deferral and profit sharing, I'm not going to be able to do that in profit sharing, but I'm going to more than make up for it in a deduction with the cash balance plan. So great question, and apologize for the little sidebar, but that's a great question. And one more just came in. Here's a great question to ask when prospecting plans. Ask the business owner, if there was no limit to how much you could put away in your plan each year, how much would you defer? I don't disagree. I've heard some good ones like that, and that's a really good one. So thank you for asking that question. All right, moving along. Actually, this was quite timely slide for that one question. The industries that we see that are primarily adopting a cash balance plan, and if you remember from this slide, green X here, steady profits, consistent, predictable. Well, what do everyone on this page have in common? Predictability, right? Your more white collar businesses tend to be the primary adopters because cash flow, revenues, profits are more predictable. They are more steady. Even in a pandemic, right? People still had to go get surgery. People still were delivering babies. People still went to the dentist, right? These businesses are again, just from a cash flow standpoint, more predictable. If you add that up, that's more than 50% of the plans are with the handful of industries. Again, but I don't want to discourage that anybody can adopt these plans. Over the last decade plus of setting up cash balance plans, I've done them for scrap yards, for builders, a lot of the trades. Trades are making a lot of money, and they hate the tax man just like everybody else. So again, your blue collar, more than a good candidate, probably a great candidate. It's just sometimes their cash flow isn't as predictable. So good takeaway here. Other kind of important considerations for any of the tax folks on the line here. Section 199A is the pass-through tax rate, right? If you can get your income below a threshold, your pass-through tax now is at 20% instead of at a higher rate. We've seen where a business owner, by putting in 250, 300,000 right now, lowers their OBI now to below this new threshold. So not only are we benefiting from a nice deduction, but now my pass-through income is being taxed at a much lower rate. So something when talking with CPAs to discuss as part of that overall tax planning. Again, mentioned the state and local taxes, protection, from creditors, competitive tool for attracting and retaining and rewarding employees. Small employers tend to again be the primary adopters of these. Again, you saw the stats from earlier, most with less than 10 employees. One more quick question before I get into, then not everything is unicorns and rainbows, right? If a dentist purchased and funded retirement through insurance, is there a way to unwind that plan and transfer assets into a cash balance plan? Not really. In fact, we do encounter those that want to use insurance as a mechanism for funding of defined benefit cash balance plans. It can be done. It's not illegal. We actually say no on our end. It's a little bit more risky when with life insurance, depending on the cash value available, right, to pay out promised benefits can become challenging. So we just say no there. But in that question specifically, you can't transfer that into a cash balance plan. But good question. So common pitfalls. Sometimes I have to say no. And it's okay. You should actually appreciate when the July sales team member you might be working with tells you this isn't a good candidate, because we're saving a big headache in the future. And some of these conversations, they're hard because we really want to, get this extra plan and we want to get the extra assets. But I'm telling you, it's better to address these up front. And sometimes I talk about terminating a plan even before we've set a plan up, because it's important to understand what happens when these plans get shut down. But on the screen, some things to consider. Similar to the green rectangle, a big takeaway I want you to recall or remember from this page is a couple. And the first one is the bottom gray left corner. Funding is non-discretionary. Let me repeat that. Funding is obligatory. There will be a mandatory required contribution every single year, barring a plan that might be frozen. We're not going to get into frozen plans today, but if a defined benefit cash balance plan included is a frozen plan, all the required contribution would be the interest, not a new pay credit, or not a new contribution. So other than a frozen plan, there will be a mandatory contribution, and it's going to be what is specified in that plan document. Now, little sidebar, there is a range of contributions that will be furnished to the business owner every year. It's called a valuation. Actuary runs the math, does all the calculations, and there's a range of contributions. Sometimes we might not be able to fund the maximum or fund the recommended, but you're going to at least have to fund the minimum. You want to stress this because if you can't fund the minimum, there are penalties that the government will assess. So I'll spare you some of the technicality there, but big takeaway, not discretionary. Funding is obligatory. Funding is required. Another is the top orange one right above it. The IRS views these plans exactly like they view a traditional pension plan. And that is, they actually call them plans of permanence. I think it's a little silly because no cash balance plan exists in perpetuity. But if you think about a defined benefit plan at GM, new employees are being hired and starting to accrue benefits. Employees are retiring, taking benefits. And it's this, sort of perpetual, cycle. That doesn't work the same way, but that's how the IRS views these. So what I'm saying is this is not a one-time tax shelter. There are many businesses that come into a windfall and are looking, for a big deduction. This can help, but this is going to be more than 1 year. Routinely, we say you want to kind of commit to this somewhere between 5 and 10 years, barring a significant change in the practice. So, for example, we set a plan up last year, and they're selling their business this year. Fine, selling business always grounds for terminating a plan. Or we're acquiring some other businesses, and it no longer economically makes sense. Fine. God forbid something were to happen to the business owner. Right. All of those things are grounds for shutting down a plan and no questions asked. I would tell you, you don't want the IRS knocking on their door. And what's the likelihood? I don't know. Probably not big, but let's just not put ourselves in that situation. Right. So we want to commit to this strategy for multiple years. A couple other things on here. Some are true, some aren't, that important. Like funding quarterly. That's only if you're underfunded or you haven't been keeping up with the funding. Contribution credit does not equal the funding amount. That is a true statement, meaning, my benefit might say I'm putting in 200,000, but next year might require 225 or 175 or something different. So that will vary. Again, I mentioned at the beginning, to change the formula requires an amendment. And then the top blue corner is actually very important as well. And that is turnover and changes in the demographics will 100% affect the plan. If I was one owner and I had 5 young staff and I lost 2 staff members and I hired 2 new individuals, and those individuals are much, much older, make a lot more money than those ones that left, I'm going to have to pay more benefits. It's just how the testing works, right? So businesses that experience tremendous turnover, just a conversation to have, right? As long as we're replacing them with like people, and we have eligibility requirements and other things. But just remember, turnover and changes in demographics will 100% affect the design. Another question, what happens when someone has hit their maximum contribution limit, or I know what you meant, accrued benefit? Well, when you've reached your max, you shut the plan down and you roll your money out to an IRA. It's really that simple. So with that, with just about, we got about 15 minutes and leave some time for some more questions. Want to share then some of the resources that the July sales team has for you all to help you market and prospect these potential opportunities. So the first, on the July website, we have an entire sitelet dedicated to cash balance. And on that sitelet, you're going to find what's on your screen here. There's going to be previous webinars and videos and education. There's calculators going to be on there. I'll share that in a moment. There's case studies, real actual case studies that we turned into marketing materials, FAQs, one-pagers, you name it. There is a plethora of information that is stored on the Cash Balance microsite. One of those things is, and I mentioned working with our CPAs, is the July sales team is able to partner with you and deliver some value-added education to your CPAs for them then to take CPE credit. Pretty simple. You do the invitations, we do the presentation. We'll furnish the certificates. They'll self-report their 1 hour of CE credit. Pretty easy to actually put on. If you're considering this, what I would recommend is actually start smaller, think smaller than grander, right? Trying to get 50 CPAs in a hotel conference room or even on a Zoom webinar is not probably a good use versus this 1 or 2 CPAs we want to work with, or that we do work with, or this firm and a handful of their accountant CPAs in their office. That's where I would start. Do it more intimately, do it smaller scale. It's going to be more impactful. It's better dialogue versus trying to get 50 people into a room together. Here is what that micro site will look like. So on julyservices.com/cash-balance, or right here, or if you go under for advisors and you click cash balance, all of this is going to come up. So again, what is it? Is it right? How do they work? Brochures on here, the case studies, the FAQs, all of that is stored on this cash balance microsite. My favorite thing on this site, and a thing that I use weekly, and feedback that I've gotten from many advisors is, hey, Smitty, we love the calculator. I'm like, great, that's why it's there. So under advisor cash balance calculator, if the individual that mentioned in the question earlier about a solo, this is for your solo cash balance 401k combo opportunities. If there are employees, I need to turn that into the actuary to run the design. But because there are no employees, I don't need the actuary. All the figures have been loaded into the calculator. So what we need is some very quick basic information. Owner's name, company name, their compensation, how that entity is taxed. Are you a Schedule C sole proprietor? Are you taxed as a partnership, K1? Are you making an S Corp election or C Corp, right? So how you're taxed, your date of birth. And then, is there a 401k, the deferral? Yes. Do we have employees? We want to make sure we ask this, because if we hit yes, this is going to stop here. And then, is there a spouse? So owner and spouse, or 2 owners, that's still a solo plan with as long as there's no employees. So put that in, put in the date, and in the bottom corner, you're going to hit execute. And what you're going to find then is this nice 2-page sort of report. And here is the report. And someone that mentioned that 6%, this is actually a great piece to validate that. So here's my maximum deferral for this year. I'm over 50. I have 6%, which you'll see right here. The profit sharing formula is 6% of compensation down there in the middle. And so that's 13,607 is the 6%. So in the 401k, 44,000 and change, and then an additional 193,000 in the cash balance plan for a total of 237 plus. At age 62, I would have accrued 1.8 million in the cash balance plan and a little less than $500,000 in the 401k plan for a total of $2.3 million. You can, back on this page, hit print. This will go right to a PDF and share it with a business owner. If you hit request proposal, that sends a note to the July team, by the way, to put together a pricing proposal for you. So really, really cool tool. You can do this all day. You don't need to have credentials. This is a public site calculator to go on. I would actually encourage you to, go out there and play around. Even put yourself in there. If you're self-employed, advisor with no staff, or your staff's, not W-2'd, you want to look, does this plan make sense for me? Put it in here. Just take a look, see what it does. It's a pretty cool, quick. I mean, that took 30 seconds, right? A couple other resources then. Some prospecting tips. We make this letter available, and then you can accompany it with some other materials. You all know as well as I do, sending letters, where do they usually end up, right? In a recycle bin or wastebasket. It's probably maybe better to do it as an email template if you're going to do it at all, and target maybe a specific business owner. And you can get lists. We can help you with 5500s, right? Lists of plans that might be using profit sharing in your area. Those might be good candidates to send a letter to about cash balance. We can look up, make sure they don't have a cash balance plan to begin with. But this template, you can certainly make your own and put it into an email template. I just doing mail. That's kind of 20 years ago, as my kids would say. That's old, right? Boomer. They call me a boomer. But certainly have these resources available, and one pagers, FAQs, important things to remember, examples, right? Some of those examples I shared, showing the what the maximum, based on age, and then real case study, right? We have a couple of them, and this is an orthopedic specialist with a handful of staff, and a family practitioner with 15 employees. So these are available out there on the website to use. Here's an interesting question. How does July make money? Well, this isn't free, my man, or there's a fee to run a cash balance plan. So we get paid a base annual fee, actuarial fee. It's a base fee and a per participant fee, but it's a interesting question. Will these handouts be shared with the attendees? Yeah, this presentation again is being recorded and will be sent with the handouts to everybody. Yes. So just a couple more. What do we need then in order to run a study for you? Similar to running a profit sharing design maybe, or safe harbor match design, I need basic census data. I do not need the census data that you submit when you are setting up a plan with Social Security and emails and addresses and all that. It really is employee 1 through 10, dates of birth, dates of hire, wages, some goal discussion, right? Are we looking for a maximum? Is there a budget, target 200,000? How that entity is taxed. If there is a current 401k plan, I want to know some information about that. Is it a safe harbor plan? What type? Are they doing profit sharing? What type? What's eligibility? Because again, these plans work together. So just some basic information. Then the July team member will work with our actuarial team to come up with a hypothetical sort of, illustration study. We will go through that together, schedule a time then to go through that with your client. And then it's not uncommon to go back and maybe make some tweaks. We had this person's age or compensation wrong, or that benefit we showed way too high. They want to do this amount, whatever. It's not uncommon maybe for 2 or 3, iterations, but before we get that right. Question, how big of a plan can you handle? Number of employees. There's no limit. At some point it becomes too expensive for the business owner to even consider, right? On average, the rank and file employees are going to need somewhere between 5-7.5% of pay in profit sharing and cash balance or safe harbor, somewhere, combined there. And then they're going to need, maybe $1,000, $2,000 or so in cash balance. You got 100 employees, do the math, right? That's, the plan will be very lopsided when you talk about efficiency, right? Business owner doing 250, but it costs 500,000 to the staff. That doesn't make sense, right? When you have high efficiency, like 90 cents of every dollar or 85 cents of every dollar going into the plan, going in for the owner or owners, phenomenal, right? So that's why, and you saw from the stats, most of these plans are small, closely held, less than 10, 20, 50 employees. I've certainly seen and set them up with more, but at some point it becomes just cost prohibitive to do a large plan. And yeah, that sweet spot, follow up to that again. It's definitely the under 100 lives, but probably under 20, under 25. One more question here. How do we get the 5,500 data from July? Great question. The July sales team members that are in your territory, you can work with them to come up with some search parameters to prospect plans in your area, right? For example, I live in, again, Columbus, Ohio. So I might say I want to do a search of all plans between $500,000 and $2.5 million and a 25-mile radius of zip code 43215. That's downtown Columbus. And it'll spit out all of them. Then we can go in and look at those that you recognize or those that are doing profit sharing. So you can see employer and employee contributions, right? You start dissecting and then you start picking out a few to maybe go after. But yeah, we're able to 100% do that. It's called Judy Diamond. If you guys have heard of that before, or our plan prospector tool that Judy Diamond has available. Can you open another cash balance plan after you hit your contribution limit and have to shut it down? Not the same company, no. If you started a new business or you're a partner of a new firm, yeah, right, you could do that. But not once you reach your max and nothing else has changed. It's the same business. No, you cannot. In terms of you all becoming actuaries overnight and cash balance experts, right? Stayed at the Holiday Inn Express commercial. I love that one. I always say I pretend to play an actuary on TV. No, we're going to lead this discussion for you or support you in any way that we can. So we'll lead the discussion with the CPA. We have a number of team members, including the actuary, that we can bring in also if we needed to get really, really deep into the weeds. Again, helping, prospect it, or excuse me, helping validate, the are you a candidate or not, and joining the conversation. That's all the role of the July sales team. We really do want to make this easy for you, right? You don't have to be the expert. We'll do the proposals and the illustrations and even partnered investment solutions. We got many great friends from like Q3 Asset Management, Sage, and Payden Regal, and a number of other great partner firms that have investment solutions geared specifically for cash balance plans. And we can help you and put you in touch with these folks. And ultimately, right, helping you expand your book and increase AUM, right? For the prospects, we try to simplify the buying experience for them. It is complex. This is complicated. But we want to do our best usually to explain in layman's terms. But again, it's important for them to know this isn't a 401k, right? There's the obligatory funding. What happens when we terminate it? How does this work? How does that work? So what we really want to do is focus on the benefits, but still cover those things that, aren't a surprise come 5-10 years down the road when they go to shut this down. Another question, is there any scenario where you would utilize this plan before a 401k? Or do they have to both be in effect at the same time? It's a really good question. For a solo plan, I would say yes. You could absolutely do a standalone solo cash balance plan and not need the 401k. That actually is sometimes common. When you have employees, the answer is almost always no. And that is because of how the testing works. It's cheaper to give the employees benefits in the profit sharing and keep their benefit lower in the cash balance. Without the 401k plan, they're going to need very large defined benefit contributions. So it's almost always paired with a 401k plan when there are employees. But that was an excellent question. And then finally here, again, some takeaways. We can't do a plan without you, right? So please leverage my team, leverage our expertise, our tools, our resources. Take me up on that CPA, webinars or cash CPE credit, sort of seminar. One of the things that I tell advisors all the time, trying to cold call prospect these plans, it's going to be pretty difficult. So your existing book of qualified plans, great starting point for, are you a candidate for a cash balance plan? They already know you, right? And so let's start with them and evaluate their company, their business, right, to see if they might be a candidate. When you go to prospecting, again, looking for certain things, do they already max out a 401k plan, stuff like that. I would encourage you to think maybe about one candidate, get with the July team to run an illustration, see what the experience is like, see what, maybe again, use a friend, use a colleague, use someone in your networking group's business or a current client. But find one for us to do this with you and see what you think, right? The one thing that hasn't come up yet that I'm almost guaranteed is a question. I'll show this first. If we set up a plan, by the way, for 2024 before June 1st, we're giving a $750 discount on the setup fee. And if we set it up before September 1st, a $500 discount. The reason is the vast majority of these plans come in at the end of the year and crush, the installation and actuarial team. So if we know we want to get this going this year, a little bit of incentive to do it ahead of time. But one of the things I want to mention, and then we got a couple more minutes for some questions. I always get, can I do a cash balance plan with a SEP? Or can I do a cash balance with a simple? So I want to make sure, talk about that. The answer is no, you cannot. In fact, with those plans, well, with the SEP, it's the only plan you can have in that year. Simple plans, newly started this year, you actually have the ability to terminate your simple plan, start a 401k, and then add cash balance. There's some nuances there with a short plan year and calculating limits, right? But prior to this year, the simple was the only plan you were allowed to do in that year. And you had to wait to the beginning of next year to do a 401k or cash balance, right? So no simple, no SEP combo plans. Just wanted to put that out there. A couple questions and then we'll wrap up here. For a solo plan, what type of situation would you recommend going with cash balance plan first over the solo? Honestly, that's really a preference. If you're a 50-year-old and you see that I can do $260,000-$270,000 in the cash balance and the extra $30,000 deferral and 6% profit sharing doesn't really do it for you, fine, just do the standalone. However, and this is a topic for another day, that difference from the maximum to what I'm able to do in the solo, okay? So again, 6%, I'm going to use simple math. Let's say it's 15,000. My 401k is 30,000. I'm at 45. That's 30 some thousand short of that maximum 76,500. This is where now a strategy with solo plans comes about, where you all heard the wonderful mega backdoor Roth, using what's called a voluntary after-tax contribution. So I could do a $30,000 after-tax contribution, my 6% profit sharing, and my $30,500 deferral. Perfectly normal, and add cash balance. So to that question, it's going to vary. I mean, there's really no negative to it. It's just if they feel like that extra, 6% or 30 isn't really worth it, and I don't need that second plan, I'll just do the cash balance, fine. Where will this recording be posted? It will be sent to all of you, and it will also be sent, stored on the July website under resources under the advisor tab. All of our prior webinars and recordings are all stored on the website. So with that, we are just at time, and I don't see any other questions. So on behalf of all the employees at July Business Services, I just want to say thank you so much for joining us today. Please be on the lookout for future webinars, and please let us know if there's anything we can do to help you in your practice. We so appreciate your continued support and partnership, and have a wonderful rest of your day and week. Take care.